From New York City, for our viewers worldwide, I'm Katie Greifeld. Bloomberg Real Yield starts right now. Coming up, the Treasury rally barrels on with overseas investors back in the bond market, all as we count down to the Fed's rate decision next week. We begin with the big issue, a downshift to the downshift.
Data, for the most part, has been mixed, but on the positive side,
the latest reported GDP,
decent amount of momentum.
Inflation beginning to peak, potential for actual soft landing coming in.
Some relief into the market.
But the outlooks are generally quite negative.
All these job cuts and hiring freeze announcements with a still low unemployment rate.
This divergence between the forward-looking sentiment gauges plummeting, but we've yet to see that in the hard data.
I don't think the Fed is satisfied.
I'm not expecting any of this pivot or sort of Goldilocks scenario that you see playing out in the bond market.
Far too early to already price in a Fed pivot.
It is prudent to slow the pace of hikes.
The market is actually, in my view, underpricing the risk of hikes for this year.
Next week's meeting does take on significant importance.
Joining us now, I'm thrilled to say we've got BlackRock's Gargi, Chaudhuri, Morgan Stanley's Vishy, Tiruppatur, and Will Smith of AllianceBernstein. Great to have you guys with us. And Gargi, I want to start with you because needless to say, all eyes are on next Wednesday, and we have everyone and their aunt saying that it's going to be 25 basis points. Is there any risk of a hawkish surprise?
Good afternoon, Katie. Happy New Year. It's great to be here. And yes, there is a risk of a hawkish surprise, but not on the rate level. So, of course, the chair is going to have a press conference afterwards, and that's where we should be focusing. So it's going to be a 25 basis point rate hike. That's what's priced by the market. But when he speaks at 2:30, I think there's a very high likelihood that he's going to bring back some of the comments that we've already heard, which is going to be around higher for longer, this idea that prematurely tightening or prematurely letting financial conditions get too easy is going to be not great for the economy, that price stability is really important, otherwise the economy doesn't work for anyone, and then continue to reiterate higher for longer. So I think that is something we're going to hear, and the hawkishness will come at 2:30 p.m., not at the actual meeting.
Well, Vishy, that's the thing. We get a decision at 2 p.m., you have a knee-jerk reaction, and then the chair starts speaking at 2:30 p.m. and everything changes. So when you look ahead to next Wednesday, what kind of Jerome Powell do you think that we're going to get?
I think we'll be very, very much focused on the what kind of a forward guidance we can infer from his comments, in particularly what he says, how he responds to questions during the press conference. Clearly, I expect that they will ask questions on the data, how the prospects for soft landing have improved, and what is the reaction function of the Fed on the back of that. There is some evidence of, on some metrics, you can see that the inflation is trending lower. In fact, a lot of those types of questions would be asked, and we will try to go through, as many of my colleagues here would, every word and to infer what the potential forward guidance from here would be. But the 25 basis point, I totally agree with Gargi. There is no question in my mind it would be a 25 basis point hike.
So, Will, when it comes to Wednesday, it's all about the presser, it's all about the guidance. But looking beyond Wednesday, there's a lot of optimism built right now on the idea that the Fed is getting close to the end of its tightening cycle. Where do you think we are in that journey?
We're pretty far along, Katie. The market is really anticipating and starting to price ahead of the Fed that this hiking cycle is near its last legs, and that the Fed is going to actually have more flexibility because inflation has started to cool. So when you look across markets, a lot of markets are pricing in kind of this Goldilocks scenario of where you're starting to see inflation come down to more reasonable levels. And at the same time, the economy is still actually in pretty good shape. You don't actually see that much in the hard data in terms of job losses, et cetera. And that's a great scenario for the Fed. But our worry is that the market is a little bit ahead of itself in pricing that in. There are still a lot of risks kind of to Gargi's point, that the Fed has to be a little bit more hawkish, and that the Fed is a little bit concerned that asset prices have gotten ahead of what they're expecting to do, given what we've seen on the inflation front.
Well, as we potentially near the end of that tightening cycle, we do have a bit of a debate breaking out among some real heavyweights. We're talking about Mohammed El-Arian of Bloomberg Opinion. He wrote this week ahead of the Fed decision that I'd rather get the tightening out of the way now than when the economy weakens. I'd go for 50. So that's one view. And then on the other side, you have former Treasury Secretary Larry Summers saying that I don't think it's a time to be committing to rate hikes, given the indications of softness that we have seen from a number of quarters. He wrote that the Fed needs to maintain maximum flexibility in an economy where things could go either way. So, Vishy, I want to bring that to you. And when you weigh those different viewpoints against each other, you see what we're actually getting in terms of the economic data. What would a policy mistake look like in this cycle?
I think the policy mistake would be, not being flexible enough. I think the Fed would want to keep as much flexibility that they can possibly keep and react to incoming data. And this is precisely what we expect to hear, is that the Chair Powell will reinforce that the incoming data is at the center of their thinking, and they will be very much data dependent and keep all the options open. And I think that is an important, as opposed to pre-committing to any specific course of action. I agree with Larry in that, Larry Summers in that expectation that retaining flexibility would be the most important thing. And I expect to hear more of that along that in that kind of tone at the press conference.
Well, Gargi, one of the pillars of El-Arian's argument for why the Fed should fire off another 50 basis points next week was this dramatic easing that we've seen in financial conditions really since mid-October or so, the end of September. When you think about that and this real bounce that we've seen in risk assets, what does that mean for the Fed's goal to cool inflation back to 2% here?
Sure. So I'll weigh in on the first question, which is around, where would the policy mistake be? And I think the policy mistake would be if they didn't maintain the optionality. So by going 25 basis points, they maintain the optionality to go 50 if they needed to in the March meeting, or continue at a 25 pace for 2 more meetings, depending on how, of course, the PCE and the CPI data comes out. And to your point around the easing of financial conditions that absolutely has taken place, a lot of that, I would say, has certainly been around, movement out of cash to buying bonds, to buying equities. Equities obviously are having a very strong year, but I don't know how much of that is fundamental driven. I would argue that some of that is much more technical driven, where especially on the bond side, people are waking up, investors are waking up and looking at this incredible yield of dreams that I like to call it that's available, and rushing into fixed income ETFs, for example. iShares ETFs, as I know like to follow, have had about 15 billion in inflows so far this month. So back to the Fed, I think they have this delicate balance where on one hand, inflation still remains at a much higher than their target level. Yes, slowing down, but nowhere near 2%. On the other hand, pockets of the economy are slowing down. But whether we look at personal income and spending, whether we look at the industrial production data, whether we look at retail sales, durable goods, there is slowdown. Other than the labor market, everything else is weakening. So at this juncture, they need optionality. So go 25 and then go higher or lower if needed, as the data shows.
Well, Gargi, you're definitely speaking my language with the bond ETFs. It was a big story last year. It's going to be a big story this year. But, Will, I want to get your view here on what a policy risk would look like. So in your view, what's the bigger risk, that the Fed over-tightens or that they end up ultimately not doing enough?
I think the bigger risk is that they end up not doing enough. I mean, what we learned back in the 1970s, and the Fed has pointed this out many times, is if you declare a victory too early on inflation and it comes back, then you really need to inflict economic damage to kind of right the ship. And they want to avoid that mistake. So in our view, them not going high enough or for long enough which results in higher inflation for longer, is the policy mistake, because that will end up resulting in a much deeper, longer recession like we saw as a result of the 70s. There's certainly a policy mistake potential for them going too far, but we need to be data dependent, and the Fed has said this many times. As long as the data continues to weaken, that gives the Fed more flexibility, and that's what the market is going to be entirely focused on: the continued deceleration of inflation and hopefully some weakening in the labor market.
And we have to talk about on this week, on this month, just the incredible strength that we've seen in the Treasury auctions. I mean, it seems like one category of investors who are really buying into the idea that the Fed is going to pivot at some point is overseas investors, because if you look at the indirect bidder categories, we've been seeing record shares taken down by that class of investors. And Vishy, to me, I mean, I've always been told that includes overseas investors, it includes global central banks. So if you go with that logic as well, why do you think we're finally seeing foreign buyers come back into the Treasury primary market?
I think my thinking about this is pretty straightforward. I think the market is convinced, including the foreign investors, who are convinced that in the face of a slowing economy, that we have clear evidence that the economy is slowing. In the face of inflation coming down, whether even if we don't get to the 2% anytime soon, but the directionality is clearly evident. And we might you combine these two things, and I think the market is effectively betting that the Fed will not be able to keep policy in this restrictive territory for a very long time. So it is a question of how long will the Fed keep this restrictive monetary policy, and in the face of somewhat pickup in unemployment, employment situation overall weakening, growth slowing, inflation coming down, and the global markets participants are betting on this calculus changing, which is in contrast to what the Fed's messaging thus far has been. To our own view, the view of our U.S. economist, U.S. chief economist Ellen Zentner, is that the Fed will keep the hike once more and hold it through the much of the year, and the cut will come only in December. That's our view. I think market is betting that the Fed will blink before that.
Gargi, Chaudhuri, Vishy, Tiruppatur, and Will Smith, everyone is sticking with us. Up next, it's the auction block. Regional banks take the place of the big six U.S. banks. Details next. This is Real Yield on Bloomberg. I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the auction block, where we start in Europe. And stop me if you've heard this before, but regional debt sales have already set a record in January, with the total surpassing 275 billion euros. Over here in the U.S., we focus on the banks, not the big banks, but the regional banks. U.S. Bancorp is the highlight of the week, with a deal garnering a peak book of more than $15 billion. And in high yield, issuers continue to churn out deals, with sales for the month now topping $15 billion, with more than 1/3 being energy companies. Keith Lerner of Truist taking caution in credit amid a potential recession.
Our main message this year is keep fixed income simple. Stick with high quality. Look at high yield spreads. They're back to where they were in the middle of last year. Look at triple Bs. They've collapsed. So the market right now is pricing in a soft landing. If you have any type of recession risk, you're not even baking in any of that. So we think there's risk of spreads widening later this year. And again, we would keep it simple.
Still with us, we have Gargi, Chaudhuri, Vishy, Tiruppatur, and Will Smith. And Gargi, for weeks, investors on this show have been telling me that they favor IG over high yield, that this is an up in quality world. And yet you see the riskiest parts of the bond markets rallying. How do you explain that?
Part of it is supply. I think in the high yield markets, obviously starting out the year and going into the end of last year, we didn't have as much supply. So part of it could be explained by that. And obviously this year has also been sort of like this Goldilocks pricing that's taking place, right? So we had that weak CPI number and everyone almost immediately started rejoicing about there being 2 Fed rate cuts by the end of 2023. I think it's still too early. It is just January 27th. I think we are going to see a significant slowdown in the second quarter and third quarter, which will have impact on, high yield spreads, which will have impact on perhaps where the equity market is, where earnings growth are going to get moved lower. So I think it's still too early. Yes, high yield has led in the first month of the year, but I still think investors should be looking at investment grade and, if anything, the front end of the IG credit markets to really pick up that high quality carry.
And Vishy, just for some context, we have CCC debt. It's experienced the best performance since 2003 on a total return basis. So when you think about that, you think about this big rally that we're seeing in more of the riskier parts of the bond market. Does that make sense to you? Is that tempting?
I think, what we are seeing really is, an influx of asset allocation flows into the fixed income markets, driven by the high yield. We called our outlook for 2023 the year of yield. I think that is what. So there is a huge influx of yield-based buyers. And the yield-based buyer in technical as showing up, as I think, as Gargi pointed out, in ETF flows and across the board in fixed income. So that is really what is being reflected here. So our preference remains higher quality over lower quality. But if you look at the high yield bond component, I would contrast the high yield bonds with the leveraged loan world. You can take some comfort in that the high yield bond index actually has meaningfully gotten better over the last several years. It is not the same high yield bond index that used to be 10 years ago. It is much more higher quality, more closer to double B than to single B, unlike in the leveraged loans, which quality has deteriorated. So I would consider high yield, broadly speaking, high yield in that vein. And we continue to advocate for higher quality fixed income, both front end, and there are interesting opportunities, some in other parts of the credit markets, in other tenors as well. But that is what we are telling our clients, is to focus on the high quality, high carry opportunity that still remains, even notwithstanding the rally we have seen, the opportunity set is still attractive.
And Will, you're the director of high yield research, so I have a feeling that probably you like high yield, but let's get specific. Let's keep talking about the CCCs here, because there was a really interesting Citi call out this week telling high yield investors to go down the risk spectrum. They write, quote, "It may seem counterintuitive to overweight CCC paper into a likely recession. At the same time, some counterintuitive trades have worked well recently. Markets are off to a strong start as low quality paper leads." Will, how sustainable is this rally in CCCs?
Well, it's sustainable in the sense that the technical backdrop still remains very robust for credit. We essentially had zero supply throughout the course of last year. And while we've seen some supply this month, it still pales in comparison to the amount of built up demand that we have for high yielding fixed income. There is a reason why most houses are going out to the street and saying that bonds are back, because we haven't seen this type of valuation environment in quite some time. CCCs are always a little bit of a different animal. You want to be very selective. There are going to be very clear losers in this situation because rates are up so much. Companies have had a lot of leverage on balance sheets. And quite frankly, those capital structures might not necessarily work when you have the cost of debt up so much. So we prefer picking our spots in parts of CCCs that aren't quite as levered, and we think actually have the ability to withstand a weakening economy. But we think the better opportunities is buying heavily discounted bonds in the double B space that have really gotten killed by more of the rate story and less about spreads. And if we think about where the biggest repricing has been this cycle, it's really the front end of the Treasury curve. So any way that you can get more exposure to the front end of the Treasury curve, that's what we think has the best risk-adjusted reward today.
All right, guys, great conversation so far. We're going to keep it going. We have Gargi, Chaudhuri, Vishy, Tiruppatur, and Will Smith, everyone sticking with us. Still ahead, it's the final spread. The week ahead, a monster week for markets with rate decisions from the Fed, the ECB, and the BOE. We're going to discuss next. This is Real Yield on Bloomberg. I'm Katie Greifeld. This is Bloomberg Real Yield, and it's time now for the final spread. The week ahead, coming up, we have GDP data out of Europe and then PMI numbers out of China on Tuesday. And then finally, it's the Fed's rate decision, Chair Powell's news conference on Wednesday. That's followed by decisions from the ECB and the BOE on Thursday, plus another round of jobless claims. And finally, another big day with the U.S. payrolls report on Friday. Before we get there, though, it's time for the rapid fire round. Guys, I'm talking 3 questions, 3 quick answers. Gargi, I'm going to start with you. And the question is, does quantitative easing last through 2023?
Yes.
Vishy?
Yes.
Quantitative tightening, you meant, right?
Quantitative tightening. You are so right. Vishy, what's your answer on quantitative tightening?
The current path of quantitative tightening that's underway will continue through the end of the year.
Okay, Will?
Yes.
Okay, Gargi, does the Fed get to 5% this year?
Yes.
Vishy?
No.
Will?
Yes.
All right, guys, final question. This one I stole from John Farrow. I told him I would give him a name drop. The question is, Gargi, who hikes more this year, the Fed or the ECB?
ECB.
Vishy?
ECB.
Will?
Fed.
Say that again?
The Fed.
The Fed. All right. Gargi, Chaudhuri, Vishy, Tiruppatur, and Will Smith, thank you both so much. Really appreciate it as we count down to that big week next week. We're talking about the Fed's rate decision on Wednesday. The consensus is for 25 basis points. We'll see if we get a hawkish Jerome Powell at 2:30 p.m. From New York, though, that does it for us. Same time, same place next week. This was Bloomberg Real Yield, and this is Bloomberg.